board, Neeraj Diwan, find out what he's been up to. Neeraj, hi, good morning. We were just talking about the dominance of SBI after its earnings. Literally a one-way move, and the rest of the PSB pack, the rest of the private banking names as well, left behind. You still think, Neeraj, there's opportunity to buy into SBI at these levels?
Yeah, good morning. Yeah, I've been positive on PSU banks, and the kind of tenor results SBI came out with, I think it makes sense to still stay invested in SBI. In fact, it's still a buy on dips kind of a stock, and if someone is already invested, they should hold on to it because valuation-wise, they could be still available at less than 1.5 type book, and historically it has gone even as high as 1.6, 1.7, and with this kind of earnings and the growth that the balance sheet can give them going ahead, I think at this price, State Bank or even other PSU banks, still there's a valuation comfort and they can still give you decent return from these levels also for a long-term investor.
Neeraj, how do you see some of the CV makers? Ashok Leyland numbers were decent numbers which came in. They've been able to, manage the cost inflation with some operational leverage there, and they're seeing the CV cycle coming back, especially replacement of CVs coming back.
Yeah, I feel that the CV cycle is already doing well right now, and they should continue doing well in this quarter also. I think capex is picking up, which was delayed earlier, which we saw last second and third quarter, but now from the third quarter onward, you're seeing a meaningful pickup there. Even some of the equipment manufacturers for CVs have been, shoring up their capacities, and I feel that CV for this quarter also can give you a good surprise, looking at the back of the capex and the capex pickup.
Right. Okay. In fact, here's another piece of news, and the Reserve Bank of India has tightened the screws now on bank sales practices. Now, under the draft norms, effective July 1st of this year, banks can no longer push insurance, credit cards, or other financial products without clear and separate customer consent. Forced bundling is what basically the RBI is opposing. In fact, we've got Anurag Shah with more details on this.
From last 1 year, ET now was raising issue of mis-selling through banks, and finally RBI has issued new guidelines, draft guidelines on mis-selling of product through bank branches. So these guidelines will be known as Responsible Business Conduct Amendment Direction 2026, and new rules will be applicable from 1st July 2026. Under the new draft guidelines, clubbing of two products is not allowed, and if mis-selling is established, then banks are supposed to refund complete amount to the customer. Another highlights of the draft guidelines is a separate consent is required for each product and services, and RBI has also defined and banned dark pattern in digital interface. So false urgency, forced action, subscription traps also prohibited under the new guidelines. And banks must maintain public list of their DSAs and DMAs, and telemarketing time also restricted from 9 a.m. to 6 a.m. Bank cannot market their third-party product as their own, and customers are free to buy product from other service providers also, other companies also is also mentioned in the new draft guidelines. So message from RBI is that aggressive cross-selling under scrutiny and a strong push toward the responsible banking conduct. So if we talk about insurance sector, then companies like SBI Life derives 60% of their business from bancassurance channel, HDFC Life 65% of their business, and for ICICI Prudential around 30% of their business is through bancassurance channel. So we are likely to see the impact on these life insurance companies also.
Okay, this obviously could be big, but we need to wait and watch, because we need to see how this will likely play out in terms of an impact. Of course, Morgan Stanley prima facie of the view that this is still in draft stage, and therefore there still has to be more clarity with regard to the impact of this. Also saying that largely some of these companies are well placed to cushion the impact if at all it were
But the
to come.
banker channel is pushed as a combo or a bundled product.
That is true.
And if that is the thing which is there, then all the it's a revenue loss for many of the banks, especially those who have mortgage as one of the products. It could be SUC Bank, ICICI Bank, it could be Axis or SBI, because banker plays a banker commissions has a bigger it's a non-fee income for them, right, in that sense. So that's one. And from the insurance point of view, there could be an impact on sale of these products, especially mortgage or credit linked products which are there.
I will read out what quote
Stanley.
unquote what Morgan Stanley's view on this is. It appears the group credit insurance attachment to microfinance could require some operational changes and or face some impact. We think the regulatory approach is consultative and prima facie. The impact on insurers is manageable, is what they have said to this draft. So that's something to keep your eye out on.
And
Neeraj, I wonder,
just to give you an indication, these products have very high margins, because if you're taking a mortgage from a bank and it's clubbed with them, the customer is forced to take that insurance,
Yes.
and which means that it's a very high margin. Now, the moment you separate it, then it becomes competitive pressures come into play, and I don't need to have this kind of product with me in that sense. And upfront margins are taken, upfront commissions are taken, by the way. Upfront pricing, everything is taken upfront.
That's true. Neeraj, I
That
wonder
is the
if
point, right? So, yeah.
Neeraj, I wonder if you have a view on this.
I think it's still early to say, but then we'll have to see, even if these guidelines come into force, you'll have to see how much proportion of which banks, revenue comes from this, combined sort of packaged product. But definitely for a consumer, it may be better because, to get more transparency, he's fully aware of what he's getting into. So I think for a consumer, this may be good news, but for banks, it will depend on case-to-case basis what kind of proportion is there in their revenue income.
Okay, that's no forced bundling. That is what the Reserve Bank is now pushing hard for. Other than that, just look at what else is happening within the rest of the world. And you've got oil prices, which have been inching up another 1.5% higher. We're now almost touching that $70 per barrel mark. Bitcoin has, continues to spiral down. It's now back to those $66,000 levels. Other than that, of course, you have Trump, who's now considering a withdrawal from USMCA pact. Robinhood markets fell about almost 9%. Mixed earnings is what actually entailed or rather led to that. And you have the US 10-year yields rallying about 8 basis points before finally paring their gains. The handover from the globe, of course, is a lot more muted, much like the sentiment in our markets at an index level, of course. Other than that, just looking at the weak links in the market, and that definitely continues to be IT. Neeraj, IT still in a void because about a quarter back, people were bottom fishing in IT, anticipating that things would finally turn around. What's your call?
Yeah, actually, definitely some bottom fishing did happen last quarter. And even when the initial results were declared, Infosys, the kind of guidance and the results, and people were getting a little positive, but then this bad news came from Anthropic. So I think IT still, I think for a investor, I think you can avoid it right now because there's too much of volatility which is there in the sector, too much of this, changes which can happen going ahead. So I think it's better to avoid right now because we're not sure in the next 6 to 8 months what kind of changes or what kind of news flow from AI and related will impact the earnings. The kind of news which has come in the last couple of weeks has been pretty worrying also. So that can have impact, but to what extent we still to see. But definitely some impact will be there on IT companies, and there'll be a lot to think and change in business models, how IT companies behave and how they function also.
Okay. Neeraj, I wonder, again, before I go to my next question, and really Lenskart was the question I was coming to, we need to slip into a very short break. We'll continue conversation both with Neeraj as well as Kunal on the other side. Stay with us. They can open another 4,500 stores on the current base, which means that they can literally 3x stock count from here. and thereafter only do they see some possibility of a slowdown with regard to growth. Do you believe that some of these factors make Lenskart a compelling case, at least at this point?
Yeah, actually, so first thing on the numbers were definitely good, and after the IPO, this kind of a numbers are positive for the company. But second, everything comes at a valuation. The stock is already at 81,000 crore market cap. They did what even if they do about, at the current run rate, they're doing it 134 crores profit. Even if you do 600 crores, still it's a very, very expensive stock. ROC is very weak. It's, I think, 6-7% ROC business. There are definitely better opportunities in the market. One has to play the growth. I agree to some extent, but then growth also has to come at a price. So it is an expensive stock. So I will not say it's a compelling buy. Maybe if you get some correction in the stock, then maybe one can look at, buying it for a long term. But I think still it's very expensive. And if you compare to already listed strong players like a Titan, which is, maybe 3,77,000 crore market cap, but then the ROC is 36, 37, going towards 40%. You can't. So there are much better opportunities in the market right now. So even if you want to buy growth, it has to come at a price.
Right. Okay. In the meantime, lots of other numbers that the market is going to be reacting to and awaiting as well. But let's first start off with the weak set that we had from LG Electronics. And Snehi is here to highlight or give us the fine print of those earnings.
Well, yes, so if you take a look at LG Electronics Q3 numbers, all across weak set of numbers coming in. And what's interesting is LG Electronics stock price continues to be below its listing price. But other than the listing day, the stock price has never actually crossed the listing price. So that weakness for LG has persisted. This time around also on a consolidated year-on-year basis, revenue has fallen by about 6.5%. The EBITDA is down a whole lot of 42.5%. Net profit has taken a knock of more than 60%. And the margins have also very significantly contracted to 4.8% compared to 7.7% this time last year. Segmentally, weak show from home appliances and air solutions, where sales were down about 10% on a sequential basis and about 30% on a sequential basis and 10% on a year-on-year basis. The EBIT margins have also shrunk here. Decent show coming in from the home entertainment segment, where sales have risen about 2% on a year-on-year basis, and on a sequential basis it's a quite significant jump coming in, but the EBIT margin is under a lot of pressure for home entertainment too. In terms of what the management commentary is, they say that the revenue drop reflected soft demand and post-festive sales, especially when it comes to compressor-led products, which is your air conditioning. Margin declined due to combined effect of subdued sales impacting operating leverage and increased input costs and currency-related headwinds as well. But they also say that despite near-term softness, underlying brand strength supported the market share gains that they have seen across key categories, and demand recovery and strong fundamentals are expected to drive growth momentum in the coming quarters. They're also positive that compressor-led growth will be seen when the summer comes, so that is something to watch out for. In terms of their Q4 outlook, they're saying that the new BEE rating portfolio will aid consumer preferences and demand. Compressor-based products will pick up in the summer, expanding premium portfolio and strengthening LG Essential pickup line. So this is also a key positive, and product innovation will also support growth. Lastly, taking you through what the brokerages are making of these numbers, Axis Capital has maintained its buy rating and its target price, but it's ICICI Securities that has maintained buy but trimmed the target price. Morgan Stanley on the flip side continues to be bullish and maintains an overweight stance. So that's the take on LG's Q3 numbers all across a weak set.
Okay, thank you so much for that, Snehi. Kunal, I know that you'll have very, very limited chart history on this one, but if at all we can get something, what's the chart looking like on NLG? What should a holder do at this point?
See, again, limited chart history, the stock in this span of the last 4 months, I think if I'm not wrong, September 2025 is where it was listed, September, October. And from there on, the stock had fallen from 1750 levels to almost 1300, 1325. It's just that I think in the last 2 weeks or 3 weeks, there has been good buying, which we've seen across many of these events-related stocks, whether it's Amber, whether it's Blue Star, Voltas, Havells, etc. So I believe in that context, even this stock has seen a short covering or maybe a bounce as such, but then it's not able to surpass about the immediate resistances. I think the first set of resistance for LG Electronics is around the 1600 mark, and the stock has not been able to surpass those levels. So again, an evolving chart, but I think if 1600 gets taken out, that's where we will probably anticipate that there could be some bit of stability and maybe a bounce back towards the life highs of 1750 levels could be seen for the stock.
Okay, that's that on some of those EMS plays and, or rather, white good company plays and how they're actually stacking up to an LG, although with limited chart history on LG. But Unilever is also set to report its numbers. Let me take it back to Snehi and find out what the ET Now poll is penciling in.
Well, yes, so if you take a look at what we're expecting from HUL this time around, we're expecting a very muted set of numbers, because also remember that this is going to be the first quarter where the numbers are going to be reported ex their ice cream business, since the demerger is now completely done. So on a consolidated year-on-year basis, the revenue is expected to come around 16,156 crore rupees, a minor uptick of 2% on a year-on-year basis. EBITDA is expected to rise by 2% too. Now, when it comes to the net profit, two segments here. The reported net profit is seen at 2,600 crore rupees, which is down 13% on a year-on-year basis. But if you take the PAT adjusted for the ice cream business demerger, it is seen constant or rather flat at 2,600 crore rupees. So we're not expecting to see any big surprises on the profitability front too. But yes, the impact of the demerger will be reflected on the PAT numbers. So we'll see how much that impact is. Margins are expected to be flat at around 23.3% this time around. So if you take a look at the key expectations, the underlying volume growth is seen to be around 2 to 3% if you exclude the ice cream business. Now also remember, on the GST front, 40% of HUL's portfolio was impacted by the GST changes, and the management had said that all of quarter 2 and the first half of quarter 3, the impact will continue to persist. So all eyes are going to be on the commentary of what the GST implication has been, how much it has been, and if that is behind the company. Low single digit underlying pricing growth is expected, and segmentally, home and personal care is expected to grow 3%, beauty and well-being 8%, and F&B revenues we're expecting to see a 2% hike. On a like-for-like basis, margins seem to have contracted slightly if you exclude the ice cream business, so we'll be watching out for that as well. Lastly, when the numbers do come out, it's going to be synergies from the ice cream business that we are going to be watching out for. Growth outlook, any commentary on GST, inflation, pricing and raw material prices, their outlook on the same. So watch out for all of this, and HUL numbers will be out later today, largely expecting a muted set.
Okay, so that's with regard to HUL. I wonder, Neeraj, if you have a view with regard to any of these, with regard to how you looked at, for example, an HUL in terms of what to kind of pencil in going forward, because this is one of those which has again not given any returns for 5+ years now. In fact, 6+ years, if I recall right. So very low to no returns. Is this an opportunity to start buying into consumption? And if so, where would you buy into?
See, I think there's an opportunity there. What needs to be seen is that post a GST benefit that the consumers have got, whether there's a volume pickup in HUL or not. So I may not be expecting better margins. Margins may still be under pressure, but if there's a volume pickup there, margins will gradually pick up maybe this quarter or going ahead, because inflation is low. So initially, when there's low inflation, it is very difficult to get the prices up, and with the GST cut happening, there was very, very difficult for them to increase the prices. So I think now going ahead, if the volumes are picking up, then let's see the results. If the volumes are picking up, then definitely there's a case for companies like Hindustan Lever, because consumption should pick up going ahead, and the kind of growth that is visible, pre-GST has changed post GST changes, and plus if a volume picks up, then margin will gradually come their way, and consumption should pick up going ahead. So I'm positive on FMCG as a space.
Rudra Murthy BV also joining us, founder, director at Vachana Investments. Rudra, I'll come to you in just a minute. Neeraj, very quickly, this LG disappointment, how big is it? And do you believe that this lower margin is something that we should come to expect of an LG? And what could the knock-on effect of that be on some of the other stocks? Because that's something we were discussing here in the studio.
Recently, there was a up move in most of these, consumer durable products companies, these EMS plays. So maybe some short-term disappointment, but I think that short-term disappointment may be an opportunity, because see, last year was a bad year for most of them, for AC, refrigerator, those kind of sales. The sales really didn't happen, and there was a lot of built up of inventory. So I think they must have let go of some inventory at lower margins, so that may have impacted. But I think that is history. But going ahead, there's an expectation that maybe this coming season, the summer can be harsher, and there's expectation that there'll be pickup which will happen in demand for their product. So I think that if there's a correction there, there's an opportunity for the next, I think 6 to 9 months, we can see better numbers coming from these companies.
Okay, that's interesting. That's the take coming in on some of those EMFs as well as consumer good plays. But let me welcome on board now Rudra. Hi, morning Rudra. What's the call on the Nifty? That struggle with 26K clearly continues.
Good morning, Aisha. Thanks for having me in the show. See, having seen a move of about 1,500 points post-budget low, this is a consolidation and market is taking some breather, which is very good for the up move. See, around budget from 24,500 on Nifty, we are now closer to the 26,000 range. And this is a 1,500 kind of a move in just 1 week. So this consolidation is very good and Nifty is moving in spite of IT not performing. So for me, this is a buy on dip market. So you got another opportunity post the Trump announcement when it came through the RBI policy where market was available at 24,500 Nifty. And even from there, you have seen a move towards this 25,500 to 26,000, which has been a 400, 500 kind of a move. So for me, after a 1,500 kind of a move, this is a good breather and one has to use any dip as a buying opportunity. I'm sure within a week or two, we should touch that all-time high levels of 26,350, 26,400 and broader market should start performing much more better. Last 2 years, you have seen a quite underperformance in broader market and that will definitely perform in the next 2 years or so from now on. And you have to pick the quality stocks where earnings are good, chart patterns are very strong and this is the place where you have to make money for the next 2 years. So I am bullish on index, buy every day. Bank Nifty will outperform Nifty and broader market will definitely do good in the next 2 years.
Okay. Rudra, I wonder what's your take with regard to the IT pack, because that pack has come under increasing strain. I'm wondering if it's an inflection point of sorts in your opinion.
Harsh, definitely IT is in a clear downtrend, whether you see chart patterns of Wipro, TCS, Infosys, might be Tech Mahindra is just a relatively better stock, but overall IT index is clearly down. Number one, don't catch a falling knife, especially if you are a short-term trader. Let the price down move settle. Don't try to be brave and then try to catch a falling knife, which I will definitely not suggest. Number two, even if you are a long-term investor, wait for prices to settle down, let it consolidate and then give some reversal pattern, then buying will be ideal. So IT is a big no for me and I will definitely avoid this for both long-term and short-term. Let prices make some bottom, spend some time at close support zones and then let us see some revival and then buy. So at this moment, clear no for IT, both for long-term investing and for short-term trading.
Okay, just counting down to the market pre-open rates to actually settle in. For now, it seems like we're headed in for a little bit of a decline. But that said, Neeraj, wanted to get your sense about whether or not you've been buying any of the earnings reactions. Anything that, you recommend buying at these levels?
I think capital good engineering infrastructure space is one space you see improvement happening as far as margins are concerned. And the order books are strong there. So that is one space where we're still looking at opportunities, still buying on even after the results. So I think that space is the kind of strong order book. I think the margin pickup in the fourth quarter is also normally strong for these companies. So that is one space I think which is still available at decent valuations.
Understood. Neeraj, last off, plenty of likely movers today, but I wonder if anything within, for example, the traveling and tourism pack attracts your attention, because Yatra came out with numbers and the numbers were largely in line. And again, it's one of those platform new age businesses. Would that at all feature on your list? Because there's a bit of a turnaround also playing out on that company.
See, Yatra specifically, I don't have a view on, but I'm positive on the hospitality sector. I feel that, hotels which have corrected after the decent up move that they saw in the last couple of years, in the last couple of quarters, they have corrected. And I think there are valuations valuation-wise have become better. So I think one should look at the large hotel chains, and definitely there's an opportunity there because the last quarter was decent, and this quarter can also pick up going ahead.
Okay, and sorry, Neeraj, very last question. Care ratings. Now the numbers were really strong, right? Revenue came in at 112 crore versus 96 crore YOY, 17% growth there. EBITDA was at 40.5 crore, 35% jump on the EBITDA count. Margins came in better than expected. You're seeing positive tailwind with regard to business very, very evidently. So is this something you'd keep on your radar, Care ratings?
Yeah, actually, I've been positive on K rating. So disclaimer, it's part of the portfolio also. So, K rating and ICRA, if you compare it to CRISIL, they are available at a decent discount to the valuation what CRISIL trades at. So K rating with these kind of numbers, I think definitely deserves a further re-rating from these levels.
Okay, Neeraj, great to have you on the show. Thanks as always for your time.
Thank you.
Let's get in some mid-cap trading ideas as well. Kunal, let's start off with you.
So I'll go with the buy on PG Electro